The term financial markets can sound pretty intimidating, right? It just seems full of complicated jargon. But what if I told you that almost all of it, the whole thing, boils down to just two fundamental choices? Well, that's what we're going to break down today, the two simple activities that are the engine behind all of finance. At its heart, it all comes down to this one question. Do you want to own a piece of something, or do you want to lend a hand to it? Seriously, that's it. This simple choice between owning and lending is what drives the entire financial world. Now, in the world of finance, these two paths have specific names: equity and debt. Equity is all about ownership, and debt is all about lending. If you can really get the difference between these two, you've basically unlocked the key to understanding everything else. So let's start by digging into what it really means to be an owner. All right, first up, let's explore ownership. So what exactly is equity? The best way to think about equity is as your true stake in something. It's not just the total value of an asset. Nope. It's the part that's actually yours after you pay off all the debts. It's your real piece of the pie. And the math behind it? Super simple. You just take all the assets, that's everything of value that's owned, and you subtract all the liabilities, which is just a fancy word for everything that's owed. Whatever is left over, that is the equity. It's the ultimate measure of true ownership. And this idea of equity, it pops up all over the place. You've probably heard of home equity, right? That's the value of your house minus whatever you still owe on the mortgage. For business, we call it shareholders' equity. And when you buy stocks on the market, you're buying public equity, your very own tiny slice of a huge corporation. This pizza analogy is perfect because it gets to the real power of ownership. You aren't getting a fixed payment. Your fortune is tied directly to how well the company does. If that pizza gets bigger, your slice gets bigger. Simple as that. But here's the flip side. If the business goes under, the owners are the absolute last in line to get paid, if they get paid at all. That's the risk you take for that potential reward. But okay, what if you don't really have the stomach for that kind of risk? What if you'd rather have a more predictable outcome? Well, that brings us to our second building block, the world of debt, where you get to play the role of the lender. In the financial markets, the most common way to lend your money is by buying a bond. A bond is basically just a formal IOU. You lend money to a government or a big corporation for a specific amount of time, and in return, they promise to pay you regular interest, and then, at the very end, give you your original loan amount, the principal, right back. The whole life cycle of a bond is actually pretty straightforward. First, you lend the money out by buying the bond. Then, for the life of the loan, you collect those regular interest payments. And finally, when the term is up, you get your original investment back. It's a very structured, very predictable way to get a return on your money. And hey, bonds aren't the only game in town. You'll also hear about things like debentures, those are usually longer-term loans to companies, or treasury bills, which are short-term loans to the government. The names might be different, but the core idea is exactly the same. You lend your money in exchange for interest. Now, this is where it gets really interesting. Some of these instruments can actually live in both worlds at once. Take convertible bonds, for example. They start out as a normal debt instrument where you're just the lender collecting interest, but they come with a very special feature. And that feature is the option to convert your debt into ownership. So if the company you lent money to suddenly starts doing incredibly well, you can literally swap your loan for company stock. It gives you this amazing superpower to switch from the safety of being a lender to the high growth potential of being an owner. All right, so we have owners with their equity and lenders with their debt. But where do all these people actually meet up to buy and sell this stuff? Well, that brings us to the marketplace. So when a company wants to raise money for the very first time by selling shares or issuing bonds, it does that in what's called the primary market. You can think of it like a brand new car showroom. You're buying directly from the creator. The most famous example of this is an IPO, or initial public offering. Okay, but what happens after that initial sale? Well, every single trade after that happens in the secondary market. This is more like the used car market. Here, investors are just trading those same stocks and bonds among themselves on big exchanges. The original company isn't involved at all. This table here really breaks down the key differences, but the most important one to remember is purpose. The primary market is all about raising fresh money for companies. The secondary market, it's all about letting investors trade with each other. And that trading is what provides liquidity for the whole system, which is absolutely crucial. Now, with millions of people trading billions and billions of dollars every single day, it could get chaotic, right? How do you keep things fair? How do you stop people from cheating and make sure investors are protected? Well, you need a referee. In India, that referee has a name, SEBI, the Securities and Exchange Board of India. SEBI's job is to watch the game, make sure everyone follows the rules, and basically ensure there's a level playing field for everybody. And SEBI's mission is crystal clear. Its number one job, above all else, is to protect investors like you and me. Beyond that, it works to promote fair practices, to stop any kind of manipulation, and it regulates the entire market just to keep things running smoothly and transparently. So you can think of it this way. SEBI is the one setting the rules for IPOs. It's fighting things like insider trading, and it's making sure that everyone has access to the same crucial information. They are, for sure, the guardians of trust in the market. So after all that, we come right back to this fundamental trade-off. Equity or ownership is like a rocket ship. It's higher risk, but it has the potential for huge, huge rewards. Debt, on the other hand, is like a train. It's a much steadier, more predictable journey with a clear, fixed destination. They're just two different paths for two very different goals. And at the end of the day, the choice you make really reflects your own financial goals and how much risk you're comfortable with. So now that we've broken it all down, I guess the big question for you is, are you more of an owner or are you more of a lender?